Joining me now at the desk is Stuart Plesser, Financial Institutions Managing Director at S&P Global. He tracks the health of the biggest U.S. banks and what their earnings are telling us about the broader economy. Stuart, happy Friday. Thanks for joining us here.
Good to be here.
All right. So today, or really this week, the headline was the big banks that reported. We also heard from some regionals really kind of driving the action, especially earlier this week. So just help us wrap up the week and tell us what were the big takeaways from bank earnings season?
Sure. So I think the earnings were good. Let's start with that. And I think they shine a lens into the economy, where things stand now. All banks pretty much showed growth in earnings year over year. Drivers, of course, was strong capital markets, and we can get into that further. Net interest income, which is their spread income, also improved. They gathered deposits, and they basically boosted earnings. And I think one of the key takeaways too is the consumer and credit was healthy, meaning there wasn't big write-offs showing weakness in the economy.
So the strong capital markets is really the Wall Street side. Obviously, the consumer side, you were talking about it shedding a light on the U.S. economy. So what broader economic signals did we get from these banks? What can they tell us about really the health of the U.S. economy?
Sure. So from the consumer side, basically spending was up, so meaning consumers are out spending their cash. They're not pulling back as was concerns back in April. Also, they're paying their bills. I think a key metric is unemployment. Unemployment's in the 4% range. You're not going to have big charge-offs coming from, the consumer sector. Unemployment would have to go further, and I think one of the takeaways was maybe softening this signs of a recession going forward. Back in April, there was very big wild card of what's going to happen. Not that there's certainty now, but I think there's more comfort of where things may go, and this spills over to the corporate world, which basically, although some still reposition their portfolios, but corporations are moving ahead, and some advisory volume is picking up. Not what it could be, but signs of strength. And as, I guess, CEOs get more comfortable as the year progresses, we could see more of this.
So is the expectation that we'll see more deals then eventually in the back half of this year?
Yeah, I would put a caveat, though. Of course, the economy and news flow is very volatile. And so if things stay in bounds with what we're seeing now and tariffs stay in line with what we're expecting, I think you could see that. But outside of that, there could be, wild cards that come up, and that could put things in a bit of disarray, but that's not what we're expecting.
You mentioned that there's not actually certainty, but it seems like a much different environment than April, where there was a lot of uncertainty. So I guess what has changed really since then that is creating a bit more confidence in the overall market and economy?
Sure. Well, I think the corporate America is getting used to this new environment. And also there was pullback in terms of the amount of tariffs. The things are not put in place yet. But I think there's more comfort of living in a world of uncertainty, and corporations you just can't stand still. We've got to move ahead with our strategic plans. And I think we're seeing some of that move through the numbers, and we'll see some of that moving through if things stay on course.
Okay, I noticed that S&P has stable outlooks on most of the big banks, but then for Wells Fargo specifically, you have a positive outlook. What's behind the divergence between Wells Fargo and the other banks?
Well, Wells Fargo, is lower rated than some of our G-SIBs, we'll put it there. And we, they had some setbacks with the asset cap when it was put in place, couldn't grow their business the way they could, but they've done a good job of staying intact in terms of their growth and ability to deliver earnings. And as well, they just recently had the asset cap removed. They still have a consent order outstanding, but the asset cap's removed. They've done a lot of work to improve controls. So we're looking for the bank to continue to improve profitability, and more so looking for what the bank will look like without an asset cap. What's the strategic path ahead and where they'll go? But it's been a good glide of the company since Charlie Scharf took over.
Okay, so bottom line is all of the banks are well positioned to kind of ride out any volatility, if you will, any turmoil. Any difference between how the big banks are doing and how some of the smaller regional banks are doing?
Well, one big difference between big banks and regionals is the big banks have the capital markets income, which was huge. The trading volume was very big. So regional banks are operating more on this spread income that I mentioned, and that's been so far so good. But with rate cuts on the horizon, that may be a headwind. Credit quality has been good across the board. I think earlier in the year, banks were anticipating perhaps there could be a recession, and some of them building a reserve, not big. I think some of them released some of that, and they set their parameters for reserve build for a more sanguine economy ahead. So there's smaller banks. We have to see what spread income and loan growth has been, I should say, modest and not great across the banking industry. So if the economy picks up, that could pick up, but that's been kind of a weak spot in general, and there's been some talk of how much private credit may be influencing bank loans, and that's a wait and see story.
We can always count on JP Morgan's Jamie Dimon to kind of wave any red flags, but we talked about at the top of the show that he talked about the economy and the consumer being resilient. Did we hear about any red flags, though, from Dimon or any of the executives as they talk about the current environment?
Yeah, I think the CEOs across the board have said things are good, but risks are not off the table. You've got geopolitical risks as well as some of this economic risk. So I think they feel in somewhat of a sweet spot right now, but are cautioned. I think Jamie Dimon did tone back some of his first quarter comments, and things have progressed, but I don't think he took risk off the table as a risk ahead.
Okay, only about 30 seconds left, but tell us what's next. What trends should we be looking for in the banking industry, especially as we wrap up crypto week? A lot of talk of stable coins and such.
Yes, stablecoin for the banking industry is going to be a story to tell as well. They want to get involved in that. But just in terms of earnings, I mean, we're expecting basically an 11% ROE for the banking industry this year, which is in line with last year. We'll probably see continued deterioration of credit quality, but nothing major. And, but we do these what ifs. What if there is a recession? How could the banks handle it? The good story is the banks are earning well, so they have a lot of pre-provision net revenue to handle credit if it were to deteriorate, but right now that's not our expectation.
Okay. Stuart, thanks so much for wrapping up bank earnings season for us. Really appreciate it.
Great to be here.